Intro to understanding investing basics. Starting off, investing in the stock market can be fruitful in returns, but also deviating when it comes to losses. That is why you have to be equipped with enough know-how to play the markets towards your advantage. You can never be right all the time, but you can still make money with minimum losses. Allow me to introduce you to the basics. What is a stock? A stock is basically a piece ownership of a public company. When a company goes public, it issues out shares or stocks to the public to buy. This gives the business value and cash capital to build and upkeep the business. Those that purchase the company stocks are called shareholders. They own pieces of the business by buying a quantity of shares from the company. These shares have variable prices that go up and down due to people buying and selling the stock simultaneously. What is a portfolio? A portfolio is a collection of all the stock investments you own at any given time. It also reflects the value of your investments as a whole with profits included. What is a return? Return is the total profit you make from a particular stock or stocks as a whole. Say you bought 3 shares of a company priced at $10 each. In total, you have a portfolio value of $30. Let's say you waited until the price jumps to $15. So now you have a portfolio value of $4 to $5. Hence, you made a return of $15. Increasing the amount of shares will increase your return, so investing more money will make you more money. What is risk? Risk is the loss you may take in a stock investment. Risk is inevitable since stock prices always go up or down. It is also present if an investment in a stock does not go as planned and you lose a portion of your initial investment with profits included. When investing in stocks, you have to make sure you invest in stable companies that will be around for years. That way, losing your whole investment won't be likely. But understand, stock prices will always go up and down, but generally for most stocks, will have exponential growth long-term. This variation of the stock prices is also called volatility. Volatility in detail. Volatility is the variant shift of a stock price at any given time. Stocks never remain positive for long periods of time. They will eventually drop down for a certain period of time, but will always tick back up eventually. The urgent question is always when, which is all dependable on the company the stock belongs to. The stock price. The price of a stock is priced based on the total value the company brings to the table. The price changes dramatically positive or negative based on the performance of the business or of things that could affect the company in any sort of way, good or bad. If sales of the business are up and positive, the stock price will go up. If the sales of the business are down, the stock price may go down. Or say, to be creative, someone says the company treats their employees like shit and intentionally disrupts their pay. The price of the stock will be affected in a negative way. To be upfront, pretty much anything can affect stock prices that can, as a result, affect your stock investments. That is why you must be knowledgeable of your investments so you know what can affect it, so you can act accordingly. Investing for the long term. There are many different ways to invest. One of them is to hold stock investments for the long term. Essentially, with this strategy, you are holding the stock for growth and for your portfolio value to go up over time. With this, you'll have to put money in growth stocks such as Apple or Procter & Gamble. Volatility isn't really much of a concern with this kind of investing because you are in for the long term and are seeking that long-term growth. Investing for the short term. Short-term investing is when you buy large amounts of shares of a business and wait for a jump in the stock price before selling. It is the complete opposite of long-term. Investing because people who short-term trade are not really looking for growth in their investment. They are just investing to make income, and that's all. However, you can do both, hold some stocks for growth, and hold others short-term to make some money while you wait for your long-hold positions to make any sort of return. Conclusion. I don't want to make this too long for you, but I made it informally to at least expose you to the basics of investing. This will give you a better understanding of how investing works, and by you actually investing hands-on, you will learn quick the business. Hope this was informational. Thanks for watching.